Hi, I am Professor Suneel Maheshwari with the Department of Accounting at IUP. And today we'll be talking about another current asset, which is account receivable. We will go over the method to account for the uncollectible accounts using the allowance method as well as the percentage of sales method. So account receivable are part of your current assets, also sometimes called trade receivables, which are received when you have an amount that needs to be collected from customers from selling your goods and services on a regular basis. Account receivable account will serve as a control account which summarizes all the receivables from all the customers. You maintain a separate account for each customer, and it is combined together in the balance sheet under account receivable. When you sell on credit, there are some benefits on selling on credit. One is customers can buy on credit, so sales and profit increases. However, when you sell on credit, you also have a risk that company may not be able to collect from some customers. These are recorded as uncollectible account expense in the income statement. And today we will be talking about how to account for these uncollectible account expense from the accounting point of view. You've got two methods. One of them is called the allowance method. In this case, you have got to you record the uncollectible account expense as part of the income statement, and you also set up an allowance for uncollectible account, which is a contra account to the account receivable, that it is shown as a reduction from the accounts receivable, and this is the amount we do not expect to be collected, so that the account receivable are reflected at the value it should. So for example, you might have an account receivable of $500 and an allowance for uncollectible account is subtracted at $25. So your net account receivable is $475. So what we are saying in this case is although we have an account receivable or entitlement to collect $500, we may not be able to collect $25 based upon our previous experience. And therefore, the value of this account receivable in the books is $475. Or you can also show it as account receivable net of $25 allowance for $475. Note that the allowance account is contra to the asset account, so it is opposite in nature to an asset account. We will talk about two basic ways of estimating the uncollectible, or also called the bad debt expenses for a business. Now, percentage of sales method is based upon the income statement, and the aging of receivables is based upon the balance sheet approach. We consider aging of receivables to be a better method than the percentage of sales, which is easier to do. The balance sheet approach is based upon creating an allowance and showing receivables at their fair value or truly representational value in the balance sheet. Percentage of sales method is very simple. You estimate the percentage of uncollectible based upon the sales revenue, and you've got the uncollectible account expense, which is an expense for the period. So let's take an example here. Let's say the opening balance of account receivable was $11,028 million, and allowance for uncollectible account was $10 million. Suppose the Apple's department estimate that the uncollectible account expense is 0.0005 of the total revenue of $156,508 million. So you can estimate the uncollectible account expense based upon that percentage of revenue. So your percentage of revenue is 1/20th of 1% of $156,508 million, which will come to about $78 million. So in this case, you record the uncollectible accounts expense of $78 million, and you create an allowance of $78 million. So how do you show this in the T accounts? You've got $10 was an opening balance. You've got an adjustment to the allowance account for $78, and your uncollectible account expense is at $78 debit. Second is called the aging of receivables method, or it is based upon the balance sheet approach. And it is based upon a percentage of uncollectible for the accounts receivable based on the balance of accounts receivable. Now, when we say the aging method, we are estimating it based upon the age of the receivables. So assume that at the year end you got a balance of $11,028 and allowance account has $10 of credit balance as we had earlier. Please note that Apple will prepare the aging schedule based upon when or how long the debt has not been collected or how old the debt is. And based upon that, they came up with a $98 million estimate. Now, how did they came up with that $98 million estimate? When you looked, when Apple observed the account receivable balances, they found that $101,164 million is about less than 30 days old. And over 90 days old is 64 million. Between 61 to 90 days is 200 million. And the assumption is as the debt becomes older, the likelihood of its becoming uncollectible increases, or likelihood that it will become bad increases. So in this case, the debt over 90 days, we are estimating 10% will become uncollectible, and then in the debt which is less than 30 days old, we are expecting less than 1% to be uncollectible. So we multiplied the account receivable balances for 30 days by 0.75 to get 76 million, and so on for a total of 98 million. Please note in this case that there was a balance of $10 in the aging schedule. So we need an additional allowance for 88 million only. So in this case, you got the uncollectible account expense at $88 and your allowance for uncollectible for $88. So what we have done is we have adjusted the balance to that $98 allowance that we need for the account receivable based upon the aging analysis. If you look at the post-date of the journal entries, you had an opening balance of $10. We needed a balance of $98. Therefore, we credited the allowance for uncollectible accounts for $88, and the expense account for uncollectible is debited by $88. Now, let's see what happens if there are some uncollectible accounts that are identified. Let's separate two debtors, RS and TM, which have a balance of 9 million and 3 million in accounts receivable. And let's assume other accounts receivable is $11,016 million. You've got an allowance for uncollectible accounts balance at $98 million. So your total accounts receivable is 11,028 less $98 million will give you 10,930. That is the net accounts receivable. In fiscal year 2003, they believe that they cannot collect from RS. So if they cannot collect that $9 million from RS, you no longer need that allowance for uncollectible account. It is reversed, increasing your balance of account receivable net, and at the same time you no longer are entitled to that account receivable anymore, and therefore that reduces its balance to the $9 million. Once again, over here we have reversed the previous. In this case, you have got the uncollectible account of $9 million. We have determined that. So since we have already determined that, to that extent, we do not require that allowance. And at the same time, since it has become uncollectible, we have reduced the account receivable balance. Now to write off the uncollectible, for how do we do that? We have got the allowance account and the account receivable at $9 million. And this is how the journal entry will be posted. Your account receivable balance for RS will go down to 0. Your allowance account will go down by $9 million. And your new balance for account receivable will be $89 million. Now, how are these amounts showed? You've got a total of 11,000. In the current assets, you had 11,028. You had an earlier balance of 98 in allowance account. Your net receivable was 10,930, and after the write-off, your balance of account receivable is 11,019, and your allowance account has been adjusted to show the 89 million after the adjustment for 9 million, leaving it at 10,930 because your adjustment is now made through the allowance account. So when you use the percentage of sales method, you adjust the allowance for the uncollectible by the amount of uncollectible account expense. In the aging of receivables method, you adjust the allowance for the uncollectible account to the amount of uncollectible account receivable. So in this case, we wanted the balance of allowance account to be 98. We already had an opening balance of 10. That's why we made the adjustment or entry with $88 million. So in this way, you create the allowance for accounts receivable using the two methods using the two methods of percentage of sales and aging of receivables to show the account receivable at the true or fair value in the books. Thank you very much for your attention.